Welcome to another deep dive. Today we're plunging into a topic that's, well, it's been buzzing with both immense promise and some pretty serious questions: blockchain technology. Specifically, we're going to unpack what's often referred to as the blockchain paradox. There's this intriguing question that I think really encapsulates our mission today. Is decentralization the future of finance? Or is it actually a recipe for chaos? Our deep dive is all about exploring that very question for you, our listener. We want to understand why thoughtful, adaptable regulation might just be the key to unlocking blockchain's truly revolutionary potential. It's really about diving deep into that delicate, often challenging balance between fostering groundbreaking innovation and ensuring user safety in this, let's face it, rapidly evolving space.
Indeed. And to help us navigate this paradox, we'll be drawing from some rich material, specifically excerpts from Blockchain Paradox, Regulation for Decentralized Future. Our goal here is to extract the most important nuggets of knowledge and insight, and to show how regulatory frameworks aren't merely about limiting this powerful technology. Not at all. Instead, when they're designed correctly, they're actually about fostering responsible development. They're about preventing the very real risks associated with unregulated blockchain activity and ultimately, well, allowing the technology to flourish safely.
Okay, let's unpack this then. When we talk about blockchain, what's the fundamental promise? What sparked this global fascination in the first place? What makes it seem so revolutionary, so appealing, especially considering, its initial draw was disrupting these traditional systems?
Well, the core promise of blockchain technology is truly transformative. It really is. It's aimed squarely at addressing some long-standing inefficiencies and, frankly, inequities in centralized systems. It fundamentally redefines how we think about unlocking financial freedom, enhancing transparency, and crucially, significantly improving efficiency across a multitude of systems, not just finance. Let's start with financial freedom. Historically, access to robust financial services, well, it's often been gatekept by large centralized institutions, right? Banks, payment processors, governments. These intermediaries, they dictate terms, they levy fees, and crucially, they often exclude vast portions of the global population. We're talking about the unbanked or the underbanked, particularly in developing economies.
Right, the numbers are staggering, aren't they?
They really are. Think about it. An estimated 1.7 billion adults globally remain unbanked. That means they can't access basic services like secure savings or credit or even affordable international remittances. Blockchain's decentralization directly challenges this status quo. It offers a peer-to-peer system. Individuals have direct, unmediated control over their digital assets and transactions.
So no need for a bank's permission?
Exactly. You don't need a bank. Okay, you don't necessarily need a specific government ID to send value across borders, and you certainly don't need to pay their often exorbitant fees for international transfers. These fees can eat up a significant chunk of remittances sent by migrant workers, for example.
That's a huge deal for many families.
Yeah, it's a massive deal. For someone in a remote village, maybe a refugee fleeing conflict, this could mean the ability to actually participate in the global economy, to receive aid directly, or maybe even access microloans through these new decentralized finance or DeFi protocols, all without ever stepping foot inside a traditional bank branch. It's a profound shift towards greater financial inclusion, individual economic empowerment. It's basically taking power from institutions and giving it back to the individual.
That shift in power dynamics is fascinating, really. So it's about removing the middleman, cutting them out. But how does blockchain then establish trust in a system without those traditional intermediaries? That seems like, well, a critical piece of the puzzle.
That's where transparency comes in. And it's a completely different paradigm of trust, you see. In traditional finance, so much of what happens behind the scenes is, well, opaque, hidden. You trust your bank to accurately record your transactions, right? But you can't truly verify their internal ledger yourself. You're relying on their audited statements, their reputation.
You just have to take their word for it, essentially.
Pretty much. With blockchain, the concept is fundamentally different. It's a distributed ledger. That means an identical copy of every single transaction is shared across a vast network of independent computers, or nodes as they're called. Once a transaction is recorded and cryptographically secured in a block, and that block is added to the chain, it's immutable.
Meaning it can't be changed.
Cannot be altered or deleted, period. Every participant on the network can verify the ledger's integrity independently. This creates an unprecedented level of trust and accountability. But it's not based on trusting a central authority. No, it's based on cryptographic proof and network consensus. We shift from a system of trust us to verify for yourself.
Wow.
Yeah. Imagine the implications for auditing public funds, tracking complex supply chains to verify ethical sourcing or authenticity, or even ensuring the integrity of public records like land titles or voting results, where disputes often arise precisely because there's a lack of verifiable, tamper-proof information.
And, okay, when you remove those intermediaries and you add that level of transparency, it must lead to significant gains in efficiency, right? I mean, traditional systems can often feel incredibly slow, cumbersome, expensive.
Absolutely. Traditional systems are often bogged down by manual processes, lengthy settlement times, high transaction costs, especially for international transfers. Those can involve multiple banks, correspondent networks. It gets complicated. Blockchain can streamline these processes dramatically. A key innovation here is the smart contract.
Yes, smart contracts. Heard a lot about those.
Right. And these aren't just digital documents, they are self-executing contracts. The terms of the agreement are directly written into lines of code and stored on the blockchain. Once the predefined conditions are met, say, a payment is automatically received, or goods are confirmed delivered via an external data feed, an oracle, the contract executes automatically. No human intervention needed, no third-party approval.
Automating the agreement itself.
Precisely. This can slash settlement times from days or even weeks down to minutes or seconds. It cuts out layers of intermediaries and their associated fees. For cross-border payments, for instance, this means money can move globally almost instantly and at a fraction of the cost. That benefits businesses looking to reduce overheads and individuals, too. It's about removing friction, automating trust, and really accelerating value exchange on a global scale.
Okay, here's where it gets really interesting for me. It's not just about financial transactions or digital currencies anymore, is it? The material highlights how decentralized applications, or dApps, are poised to revolutionize various industries, like far beyond just finance. What exactly are dApps, and how do they extend blockchain's promise into these new territories?
Exactly. That's a crucial point. dApps represent the practical manifestation of blockchain's potential beyond just currency or simple value transfer. Think of them like this. They aren't applications that run on a single company's server, like, say, the apps on your phone that rely on Google or Apple's centralized infrastructure. Instead, dApps run on a decentralized peer-to-peer network leveraging the underlying blockchain itself.
So no single point of control.
Right. And this fundamentally changes their operational characteristics. Because there's no central authority controlling them, dApps are typically open source. That means their code is often publicly available for anyone to look at, to audit for security or transparency. They're also inherently resistant to censorship. No single entity can just shut them down or block access. It makes them incredibly resilient. They continue to run as long as the underlying blockchain network itself is operational.
So it's not just about avoiding a single point of failure in, say, a payment, but in the entire application itself.
Precisely. This architecture allows them to bring that same transparency, that efficiency, that immutability we talked about for finance into a vast array of other fields. For instance, think about supply chain management. A data app could track every single step of a product's journey, from raw material sourcing through manufacturing, shipping, all the way to the consumer. This creates an unchangeable, verifiable record of origin, handling conditions, authenticity.
Which could massively reduce counterfeiting.
Dramatically reduce counterfeiting, yes. Improve ethical sourcing. Enable instant recalls if issues arise. Or take digital identity. Instead of storing all your sensitive personal data on some central server that's, frankly, prone to breaches, you could control your own verifiable digital identity on a blockchain. You could selectively grant access to specific pieces of information only when needed. Like prove your age to a website without revealing your actual birth date. That significantly enhances privacy and security.
Giving users control over their own data.
Exactly. In healthcare, dApps could manage medical records securely, giving patients much greater control over their data while still allowing authorized parties access when necessary. That could potentially save lives by ensuring swift access to critical information during emergencies. And even in governance, we're seeing explorations of dApps for secure, transparent voting systems where every vote is recorded immutably, or for managing public records, reducing opportunities for corruption, and increasing civic participation. The possibilities are truly immense because the core principles, decentralization, trustlessness, immutability, they apply across so many aspects of our lives. They promise to fundamentally reshape how we interact with data, with services, with institutions.
It really sounds like a massive part of blockchain's appeal stems directly from the inherent limitations, maybe even the failures of those centralized systems we've relied on for so long. Can you elaborate a bit more on what those specific limitations are and how blockchain offers such a compelling alternative? How does it directly address them?
Absolutely. Centralized systems, just by their nature, concentrate power, data, and control in one place, one single entity, usually. This creates inherent vulnerabilities and inefficiencies that blockchain technology specifically aims to overcome. First, there's the critical issue of single points of failure. It's a huge one. If a central server gets hacked, if the company controlling the database goes bankrupt, or even if it just experiences a major technical outage, the entire system can go down. That leads to widespread disruption, potentially catastrophic loss. Think about a major bank server going offline, millions can't access their funds, or a social media giant having a global outage.
We've all experienced those, yeah.
Yeah, right. In contrast, blockchain's distributed nature means there's no single point of failure. The network keeps functioning even if many individual nodes go offline or are somehow compromised. It's far more resilient to attacks or outages. Instead of thinking of one giant vault, imagine the information spread across thousands of individual, interconnected, highly encrypted safes. Then there's the pervasive problem of opacity and the potential for manipulation. In a centralized system, that central authority has complete, often unchecked, control over the data and the processes. This can lead to a lack of transparency. Users often don't truly know how their data is being handled or if the processes are even fair. And there's the very real potential for censorship or manipulation by that central authority.
Like freezing accounts or blocking transactions.
Exactly. They can block transactions, freeze accounts, or even alter records to serve their own interests, perhaps under external pressure, or maybe just due to human error. We've seen instances in various countries where governments might seize assets or restrict financial freedom for political reasons. Blockchain, through its transparent and immutable ledger, directly counters this. Every validated transaction is visible to all participants on the network, and once recorded, it cannot be changed. That makes it highly resistant to censorship or malicious alteration by any single entity. This inherent transparency fosters a whole new level of public trust. Finally, centralized systems are often slow, bureaucratic, and expensive, really expensive sometimes. The need for multiple layers of approvals, verifications, manual processes. It means transactions can take a long time to settle and often carry high costs, particularly for cross-border stuff. Blockchain, as we discussed, automates many of these processes through smart contracts and peer-to-peer networks. It drastically speeds up settlement times and reduces costs by cutting out those intermediaries. Furthermore, a really significant vulnerability of centralized systems is that they are, well, honeypots for hackers.
Because all the valuable data is in one place.
Exactly. All the sensitive data concentrated right there, making it an incredibly attractive target for cyber attacks. A single successful breach can expose millions, sometimes hundreds of millions, of user-sensitive information. We've seen countless data breaches over the past decade. It's almost routine now. Blockchain, with its cryptographic security and distributed nature, makes it exponentially harder for a single point of attack to compromise the entire system. So this inherent appeal solving these long-standing fundamental problems of trust, security, efficiency, that's what truly drives the initial excitement and promise around blockchain. It offers a paradigm shift, really, from reliance on trusted intermediaries to trust in mathematics and cryptography and in distributed consensus. Okay, so we've heard the incredible promise, financial freedom, unprecedented transparency, revolutionary efficiency. It sounds amazing. But here's where the paradox truly manifests itself, right? The material also points to what it calls the dark side of decentralization. If we take away those traditional intermediaries, those regulators, what are the new risks that emerge? What fills that vacuum?
This is precisely where the paradox comes into sharp focus, yes. While decentralization offers incredible freedom and removes those traditional gatekeepers, it also, almost by definition, gives rise to significant and often novel risks, particularly because of the prevalence of unregulated markets, acute vulnerabilities to scams, and some pressing security concerns within the broader ecosystem. Let's maybe elaborate on unregulated markets first. When you remove established intermediaries and their corresponding regulatory bodies, well, you inadvertently create a kind of Wild West environment. For users, this means there's often a severe lack of legal recourse if something goes wrong.
Like, who do you complain to?
Exactly. If you lose money in a fraudulent crypto project, there's no central authority like a traditional bank or a government agency you can easily appeal to for help. There's no deposit insurance, no ombudsman service, no consumer protection bureau in the same way traditional finance has. This environment becomes ripe for illicit activities because, well, Bad actors know they can often operate with relative impunity. They exploit the lack of oversight to engage in money laundering, terrorist financing, and all sorts of fraud. Without clear rules on how these decentralized entities or related service providers should operate, it becomes a bit of a free-for-all, and that makes it incredibly challenging for legitimate businesses to thrive and for everyday users to feel safe participating.
And it's not just abstract illicit activities happening somewhere out there, is it? It directly impacts individual users through, well, widespread scams. Can you delve into the specific types of scams that seem to thrive in this less regulated environment?
Oh, absolutely. This directly leads into the next major risk, vulnerabilities to scams. The less regulated, highly complex environment is just a fertile breeding ground for sophisticated and often devastating scams. Individual users are highly exposed. One of the most common and damaging types is something called a rug pull. Have you heard of that?
I think so, vaguely.
Yeah.
Where the developers just disappear with the money.
That's exactly it. Developers launch what looks like a legitimate cryptocurrency project. They often market it heavily, use social media, influencers, build up hype to attract investors. Once a significant amount of money has been invested by the public, the developers suddenly abandon the project. They liquidate all the funds they've collected, vanish, poof. Investors are left holding worthless tokens. A prime example was that Squid Game token scam back in 2021.
Oh, yeah, I remember that.
Right. Developers marketed a crypto project based on the popular Netflix show, attracted millions of dollars from investors, and then just disappeared. Investors lost everything. There was zero recourse. Another prevalent type involves phishing attacks. Now, phishing isn't unique to crypto, of course, but it's particularly dangerous here because these attacks often target users' private keys, essentially the digital keys to their crypto wallets. If a scammer gets hold of your private key, they can instantly empty your wallet. And crucially, there's generally no way to reverse that transaction on the blockchain.
Once it's gone, it's gone.
Pretty much. We also frequently see fraudulent initial coin offerings, ICOs, or non-fungible token NFT projects. Founders promise groundbreaking innovations, revolutionary products, exclusive digital art, but they deliver nothing of substance, or they just create fake assets with no underlying value. The lack of oversight makes it incredibly easy for these bad actors to launch such schemes, attract unsuspecting victims through hype and speculation, and then vanish without a trace.
So, even if the underlying blockchain itself is cryptographically secure, the surrounding ecosystem still presents significant vulnerabilities. What are those broader security concerns beyond just the direct scams targeting users?
That's a really crucial distinction to make. While blockchain technology itself is often touted as highly secure due to its cryptography, its distributed consensus, the broader ecosystem, the stuff built on top or around it, has its own set of significant security concerns. These aren't necessarily flaws in the core blockchain protocol itself, but rather in how it interacts with the real world or in its implementation by developers and users. For instance, insecure smart contracts are a major vulnerability, a huge one.
The code itself can be flawed.
Exactly. While smart contracts are powerful automation tools, if their code contains bugs, logical flaws, unforeseen loopholes, they can be exploited by hackers. Hackers can drain funds, manipulate the contract's intended behavior, cause chaos. One of the earliest and most infamous examples was the DAO hack back in 2016 on Ethereum. A vulnerability in a smart contract led to the loss of over $50 million worth of Ether at the time. It directly impacted the entire network. It even led to a controversial blockchain fork, basically a split in the network just to try and recover the funds. And we've seen numerous high-profile hacks since then where millions, sometimes hundreds of millions of dollars were lost due to vulnerabilities in smart contract code. Another significant risk is simply user error. This one's tough. Unlike traditional banking, where you can often recover a forgotten password or maybe reverse an unauthorized transaction if you report it quickly, losing your private keys in the crypto world often means losing access to your funds permanently. Full stop.
No forgot password button.
No forgot password button for your crypto wallet. No central help desk. And if you accidentally send funds to the wrong address, those assets are generally irrecoverable, gone. Users are solely responsible for securing your keys, and frankly, many people are just not equipped to do so effectively. They don't have the technical knowledge or the security habits. This leads to accidental, irreversible losses quite often. Lastly, hacks on centralized exchanges, while not directly blockchain hacks, are a substantial systemic risk.
Because that's where many people actually hold their crypto.
Exactly. Many users keep their cryptocurrencies on these exchanges for convenience. They feel familiar, like traditional online brokerages. However, these exchanges are centralized entities. They control the private keys for the crypto held on their platform, and that makes them prime targets for hackers, just like traditional banks or large data centers are targets. When these exchanges are breached, users can lose all their assets held there. Again, often with little to no recourse. Mt. Gox is the classic, painful example. So these multifaceted security challenges really highlight that security in the blockchain space extends far, far beyond the integrity of the distributed ledger itself.
That sounds incredibly daunting for the average person just trying to navigate this space.
It
It
does.
really brings home the idea that the sheer complexity of these blockchain ecosystems also plays a significant role. It makes it challenging for users to navigate safely. What does that complexity involve beyond just, the technical jargon?
Indeed. The landscape is incredibly diverse and it's evolving at breakneck speed. That complexity itself is a major barrier and a risk factor. Imagine trying to invest in a completely new stock market where there are literally thousands of different companies, each with its own unique business model, its own set of financial rules, its own internal structure, and they're all constantly changing, launching new features, pivoting. That's essentially what the cryptocurrency space feels like right now.
So many different coins and tokens.
Thousands. We have Bitcoin, Ethereum, Solana, Cardano, countless altcoins, new ones emerging daily. Each often runs on a different blockchain protocol with different consensus mechanisms like proof of work, that energy-intensive method Bitcoin uses, or proof of stake, a newer, more energy-efficient alternative used by many others. They have different transaction speeds, varying fee structures, often called gas fees, on networks like Ethereum, which can fluctuate wildly. And on top of all that, there's just a bewildering amount of technical jargon thrown around constantly. Understanding it often requires a pretty deep dive into computer science, economics, even game theory sometimes. You hear terms like sharding or layer 2 solutions, which are basically ways to try and make blockchains faster and handle more transactions. Then there's the entire burgeoning world of DeFi, decentralized finance, which aims to replicate traditional financial services like lending and borrowing, but without banks. And the explosion of NFTs, non-fungible tokens representing unique digital assets like art or collectibles. And DAOs, decentralized autonomous organizations, which are entirely new ways of governing projects or communities online.
It's like learning multiple new languages at once.
It really is. For an average user, or even someone who's tech-savvy but new to crypto specifically, trying to understand all these nuances is like trying to learn a whole new language and a new field of computer science simultaneously. And then you're supposed to apply that knowledge to make critical financial decisions. It's incredibly overwhelming. And this is all happening in an environment of constant, almost frantic innovation. What was cutting edge last year might be obsolete today. New technologies, new types of scams, new ways of interacting with the blockchain emerge almost daily. It's relentless.
So it's not just a steep learning curve. It's more like a constantly shifting vertical cliff face where the handholds keep changing and the rules aren't clear.
Yeah.
What are the ultimate navigational consequences for users trying to operate in this environment?
Well, this immense complexity makes for extreme navigational challenges. That's the bottom line. How can an average user realistically differentiate between a legitimate, well-audited project with a viable use case and a cleverly disguised fraudulent one? It's really hard. Scammers are often incredibly sophisticated. They create professional-looking websites, detailed white papers that sound plausible, engaging social media presences. They mimic legitimate projects perfectly, leveraging social engineering tactics and that powerful fear of missing out, FOMO.
Making it hard to tell the good from the bad.
Very hard. Without deep technical understanding, strong critical thinking skills, and frankly, a healthy dose of skepticism, users are highly prone to making uninformed decisions. Decisions based purely on hype, or maybe what some influencer is pushing on social media. This can lead directly to them falling prey to those sophisticated scams we discussed earlier, or even just accidentally losing access to their assets due to misunderstanding technical requirements, like sending funds to the wrong address on the wrong blockchain network, a common mistake that almost always results in irreversible loss. The sheer volume of information out there, much of it highly technical, speculative, or sometimes even intentionally misleading, contributes significantly to the difficulty of safe navigation. Ultimately, a major consequence of these unregulated markets and this overwhelming complexity is a significant gaping lack of consumer protection. And this highlights very, very clearly the urgent need for robust regulatory frameworks. Think about it. In traditional finance, if your bank goes bankrupt, your deposits are often insured up to a certain amount by government agencies like the FDIC in the US.
A safety net.
A crucial safety net. If you have a dispute with a financial service provider, there are usually ombudsman services or regulatory bodies you can turn to for mediation and redress. In the vast majority of the crypto space, such mechanisms simply don't exist yet. Where do users go when things go wrong? If you're rug pulled, if you lose your private key, there's no central authority likely to compensate you. There's often no clear legal pathway to recover your funds. This consumer protection gap means that the risks are borne almost entirely by the individual user. That makes the space incredibly dangerous, especially for those who aren't experts or who don't have substantial capital they can afford to lose. And this gap, it directly underscores the necessity of regulations. Regulations that can provide clear guidelines, enforce standards for market participants, and offer those much-needed redress mechanisms. That's how you create a safer and more trusted environment for everyone.
Okay, this brings us squarely back to the blockchain paradox then.
Yeah.
It's stark. If we have this incredible potential for global change on one side and these significant, sometimes devastating risks on the other, how do we navigate this? What's the path forward to ensure blockchain actually achieves its promise without just creating a chaotic, unsafe landscape?
The source material clearly points to the need for a balanced approach, a really carefully considered one. It's absolutely not about stifling innovation that would be counterproductive. It's about fostering innovation responsibly while simultaneously protecting users and promoting sustainable development for the long term. Think of regulation less as a leash on innovation and more like a guardrail on a highway.
Okay, I like that analogy.
Yeah. A guardrail doesn't stop a car from going fast. It prevents it from veering off a cliff. The goal of regulation here isn't to impede the fundamental technological advancements of blockchain. It's about creating an environment where the good actors, those building legitimate, valuable projects, can actually thrive and deliver real utility, while the bad actors, the scammers, the illicit operators are deterred, caught, and ultimately removed from the ecosystem. It's about making sure the rules of the road are clear so everyone can drive safely and effectively, benefiting from the new capabilities blockchain offers without unacceptable risk.
So this implies a shift in mindset for the innovators too, doesn't it? Beyond just waiting for regulators to act. This idea of responsible development seems crucial. What does that actually entail for those building in this space? What's their part of the bargain?
That emphasis on responsible development is absolutely key for the innovators, yes. It's their side of the street. It means building with security ingrained from the very beginning, not as an afterthought. Conducting thorough, independent audits of smart contracts to identify and fix vulnerabilities before they deploy code that handles people's money or data. It means designing systems that are resilient to potential exploits and also, importantly, unexpected user behavior. Thinking through edge cases.
Anticipating problems.
Exactly. It also involves providing unprecedented transparency to users, clearly explaining the risks involved, explaining the functionality of their products in plain language, making the underlying code available where possible, telling users what they can realistically expect. This goes way beyond just a technical white paper filled with jargon. It means clear, understandable communication about complex technical mechanisms and potential risks. Furthermore, responsible development entails really considering the broader societal impact of their technology, ensuring it aligns with ethical principles, promotes inclusivity, contributes positively to the world, rather than simply optimizing for short-term profit at any cost or encouraging pure speculation that benefits few. It's a mindset shift from, the old Silicon Valley mantra of move fast and break things to something more like move thoughtfully and build sustainably. That shift is crucial for blockchain to achieve its full potential and gain genuine mainstream trust.
Okay, given all of that, what specific role does regulation play in creating a truly sustainable blockchain ecosystem? How does it help move it beyond its current, often quite speculative phase?
Regulation is absolutely crucial for sustainability. Without it, the space likely remains in a perpetual state of flux, right? Driven by speculative hype, prone to scams, susceptible to these severe boom and bust cycles that just erode public trust over time. First and foremost, regulation provides much-needed clarity. That's maybe the biggest thing. For businesses looking to build on blockchain, clear rules mean they understand what's permissible, what their obligations are, how they can operate legally without constantly looking over their shoulder, feeling arbitrary enforcement or sudden policy shifts.
Just uses that uncertainty.
Exactly. That clarity significantly reduces uncertainty, which is a major barrier to entry for legitimate enterprises and, importantly, institutional capital. When businesses can actually plan, invest, and build for the long term with a clear understanding of the legal landscape, they naturally move beyond just the speculative hype of the latest token and focus on creating lasting value, building robust infrastructure. Secondly, that clarity and a regulated environment directly work to attract institutional investment. Think about traditional financial institutions, large corporations, even conservative investors like pension funds or sovereign wealth funds. They're typically bound by very strict compliance requirements and fiduciary duties. They have responsibilities to their clients or pensioners. They simply cannot just jump into a completely unregulated market, no matter how high the potential returns might seem. The risks are too great: reputational damage, legal penalties, capital loss.
Too much on the line.
Way too much. A robust regulatory framework makes these larger, more stable entities comfortable engaging with blockchain technology and digital assets. This influx of institutional capital brings not just more funds into the space, but also greater legitimacy, stability, and maturity to the market. It helps it evolve away from its current, often volatile, predominantly retail-driven nature towards something more like an established and resilient financial sector component. Finally, regulation is absolutely essential for combating illicit activity. We talked about how unregulated markets can become havens for criminals. By implementing rules like Know Your Customer, KYC, and anti-money laundering, AML laws, similar to those in traditional banking, regulators make it much harder for criminals to exploit blockchain for money laundering, terrorist financing, or other illicit purposes. When the space is perceived as safer, less associated with criminal enterprises, it dramatically improves public perception. It builds trust among the wider population, encouraging broader adoption and really legitimizing the technology in the eyes of society. It helps transform blockchain from something viewed with suspicion into a potentially powerful tool that can benefit everyone, rather than just a niche for speculators or, worse, bad actors.
That's the delicate balance the source emphasizes, isn't it? It really hammers that home. How do we encourage all this incredible technological advancement without compromising on safety and security? It really does sound like walking a regulatory tightrope.
It truly is a delicate balance, yes. And the source highlighting it as a regulatory tightrope feels very accurate. The core challenge is ensuring we encourage technological advancements without inadvertently stifling the very innovation that makes blockchain so potentially powerful, while at the same time creating a safe and secure environment for users in the financial system. That's a tough needle to thread. How do you regulate a technology that is inherently decentralized, often borderless, evolving at lightning speed, without killing its core innovative spirit?
Right, because overly strict rules could just kill it off.
Exactly. Overly prescriptive rules, for instance, could become quickly outdated. Or they could even render current, potentially beneficial innovations illegal before they've even had a chance to mature or prove their value. The key seems to be designing regulations that are, as much as possible, technology neutral and principle-based. What does that mean? It means focusing on the activity being performed, like issuing a financial instrument, offering a lending service, transferring value, rather than getting bogged down in regulating the specific underlying technology used, whether it's Bitcoin or Ethereum or some future blockchain protocol we haven't even conceived of yet.
Focus on what's being done, not how it's done.
Basically, yes. This allows for innovation within defined boundaries. It avoids outright bans or rules that try to force new tech into old, ill-fitting regulatory boxes. It's about encouraging experimentation and growth, but within clear guardrails that protect consumers, maintain financial stability, and deter illicit activities. So the next logical question is, what does this delicate balance actually look like in practice? How are different jurisdictions around the world actually trying to achieve it right now?
Yeah, what's fascinating here is how different places are already trying to tackle these challenges you've laid out. It's not just theoretical. The material mentions exploring existing and emerging regulations across various jurisdictions. Can you give us a sense of this global landscape? Is everyone doing the same thing?
Oh, definitely not. It's a truly global effort, but the approaches are quite varied. Different countries, different regions are experimenting with various ways to regulate this rapidly evolving space. There really isn't a single universally adopted regulatory blueprint right now, not even close, which means we're seeing this mosaic of regulatory models emerging worldwide. Some jurisdictions are taking a more permissive approach. They want to be seen as innovation hubs, actively trying to attract blockchain businesses. Think of El Salvador's very bold move to make Bitcoin legal tender. That's one extreme.
Right. Very controversial.
Extremely. Others are much more restrictive, prioritizing strict controls to mitigate what they see as major risks. China's near-total ban on cryptocurrency trading and mining is a prime example there, likely driven by concerns about financial stability and capital flight. And then you have more, let's say, balanced approaches emerging, like the European Union's Comprehensive Markets and Crypto Assets Regulation, MiCA. MiCA aims to provide clear, unified rules across all EU member states, focusing heavily on stability and consumer protection, but still explicitly allowing room for innovation within those rules. So despite these diverse philosophies, permissive, restrictive, balanced, indulgence, they are all ultimately aiming to address those common core concerns we've discussed: consumer protection, financial stability, and crime prevention.
Okay, let's delve into those key challenges again, but through the lens of these regulations. How are these diverse approaches attempting to safeguard users on the ground? What do consumer protection measures actually look like in practice in these frameworks?
Okay, for consumer protection, regulations are trying to safeguard users primarily by imposing stricter requirements on the market participants, the companies offering services. This often includes mandating clear disclosure requirements for projects. This means forcing blockchain companies or those issuing new digital assets like tokens to provide transparent, easily understandable information to potential investors. Information about the risks involved, the underlying technology, the project's actual roadmap, the team behind it, so users can make genuinely informed decisions, not just decisions based on hype or social media noise.
Trying to level the playing field with information.
Exactly. We're also seeing widespread licensing requirements for crypto exchanges and custodians. These are the platforms where people buy, sell, and often store their crypto. Just like traditional banks or brokerages, these entities are increasingly required to register with regulators, meet certain minimum capital requirements, and adhere to strict operational standards. Things like robust cybersecurity measures, ensuring they actually segregate client funds from their own operational funds, making them accountable for the security and integrity of user assets. Furthermore, some frameworks are starting to establish mechanisms for dispute resolution, providing clearer pathways for users who feel they've been wronged by a crypto platform or project to seek redress, maybe through an ombudsman or a specific tribunal. That's a crucial step towards providing those safety nets that are currently often lacking.
And what about the bigger picture concerns, the systemic stuff? How are regulators addressing financial stability when it comes to blockchain, especially with the rise of things like stablecoins that are meant to mimic traditional currency?
Yeah, on the financial stability front, regulators are getting increasingly focused, maybe even worried, about how large crypto assets could impact the broader financial system, especially stablecoins, those tokens pegged to fiat currencies like the US dollar, or just the wider adoption of blockchain-based financial services, DeFi. Could they create systemic risks? Regulations here might include imposing capital requirements for entities holding significant crypto assets, or particularly for stablecoin issuers, ensuring they have sufficient liquid reserves to back the tokens they issue and cover potential losses or periods of high volatility, much like banks must hold capital against their liabilities.
Making sure the money is actually there.
Precisely, making sure the money is actually there and that it's held safely. They might also require stress testing, where these companies have to demonstrate they can withstand adverse market conditions, like a sudden crash in crypto prices or a run on their stablecoin, similar to the stress tests traditional banks undergo regularly. Crucially, efforts are also underway to better integrate crypto activities into existing financial oversight frameworks, ensuring that risks related to liquidity, operational resilience, market manipulation are properly monitored and mitigated to prevent contagion, to stop problems in crypto spilling over into the traditional global economy. This definitely includes ensuring stablecoin issuers actually hold the reserves they claim, are subject to regular independent audits, and have orderly redemption processes to prevent a destabilizing run.
And finally, the persistent issue of crime prevention. How are regulators trying to stop blockchain from being exploited for illicit activities, especially given its sort of pseudo-anonymous nature?
Right. And crime prevention initiatives are absolutely paramount. The fight against illicit activities like money laundering, terrorist financing, sanctions evasion, it's a top global priority for governments. This primarily involves implementing robust Know Your Customer, KYC, and anti-money laundering AML laws specifically for crypto businesses. These laws require crypto exchanges, wallet providers, and other key service providers, the on-ramps and off-ramps, to identify their customers, verify their identities, and crucially, monitor transactions and report suspicious activity to authorities.
just like traditional banks have to do.
Exactly the same principles applied to this new context. This makes it significantly harder for criminals to use blockchain anonymously to move illicit funds around the globe. It also involves fostering much greater international cooperation among law enforcement agencies and financial regulators. They need to work together to trace illicit funds across borders, recognizing that blockchain is inherently a global technology, and criminals certainly don't respect national boundaries.
That must be incredibly challenging.
It is incredibly challenging. Illicit funds can cross national boundaries almost instantly, moving between jurisdictions with vastly different legal frameworks, data privacy laws, enforcement capacities. Regulators and law enforcement are constantly playing catch-up, trying to build global alliances, intelligence sharing networks, common standards for tracking and seizing illicit crypto assets worldwide. All these measures together aim to sort of clean up the space, enhance its legitimacy, and build trust with governments and the wider public, making it less attractive for criminal use.
Okay, so it sounds like among this mosaic of approaches, some models might be proving more successful than others in achieving that tricky balance, promoting innovation while still mitigating the risks effectively. What characterizes these more successful regulatory models, generally speaking, regardless of the specific country?
Well, while the source material doesn't point to specific countries and say, this is the perfect model, it does highlight that the successful models seem to be characterized by their ability to achieve that delicate balance we keep coming back to, promoting innovation while rigorously mitigating risks. This suggests that clarity, adaptability, and a highly collaborative approach are absolutely key ingredients for success. Successful regulatory frameworks often establish things like regulatory sandboxes. Heard of those?
Yeah, like a safe space to test things out.
Exactly. They're controlled environments where new blockchain technologies and business models can be tested under regulatory supervision for a limited time. This allows innovators to experiment without immediately facing the full, potentially crushing burden of regulation. And just as importantly, it allows regulators to understand the technology, see its risks and potential firsthand before they craft permanent, possibly overly restrictive or ill-fitting rules. It's learning by doing for both sides. Another characteristic of successful models is providing clear, unambiguous definitions for different types of crypto assets. This is huge. Is a particular token a security subject to securities laws? Is it a commodity? Is it a utility token? Is it something entirely new? Different classifications trigger vastly different regulatory treatments. Clear definitions reduce ambiguity, allow businesses to understand precisely which rules apply to them, fostering compliance and reducing legal uncertainty that chills innovation.
Makes sense. Less guesswork.
Much less guesswork. Successful models also often employ technology-neutral laws, as we touched on earlier. Instead of trying to regulate blockchain itself, which is hard to define and constantly changing, they regulate the activity. Issuing a digital asset, providing a financial service, operating an exchange, regardless of the specific underlying technology used today or tomorrow. This makes the regulations far more future-proof, far more adaptable to new technological advancements without needing constant legislative rewrites. Lastly, these successful models seem to foster an environment where legitimate businesses can actually understand and comply with the rules without undue burden. They encourage innovation rather than pushing it underground or forcing it offshore to less regulated jurisdictions. It's about striking that balance by being proactive, understanding the technology deeply, and crucially, working with the industry through dialogue, rather than just reacting with blanket bans or ill-informed restrictions based on fear.
Okay, if we connect all of this to the bigger picture now, looking ahead, it really seems the future of blockchain isn't just about the technology itself or even just isolated national regulations. It's about how we collectively manage it. The source really emphasizes the critical importance of collaboration. What does that truly mean in this context? Who needs to collaborate?
Absolutely. The future of blockchain and its ability to actually realize its full positive potential hinges completely on deep, ongoing collaboration. Collaboration between governments, industry leaders, and regulators. This isn't a problem one group can solve in isolation. It's impossible. It requires a sort of symphony of understanding and cooperation. Governments and policymakers desperately need the industry's technical understanding. This technology is nascent, it's incredibly complex. Legislators often don't have backgrounds in distributed ledgers or cryptography, so they rely on input from those actually building the technology to understand its capabilities, its limitations, its unique risks, and importantly, its potential for good.
Otherwise, the rules might miss the mark entirely.
Completely. Without that informed input, regulations could be misinformed, they could inadvertently stifle beneficial innovation, or maybe even create unintended loopholes that bad actors can then exploit. Conversely, the industry needs regulatory clarity to build and innovate confidently. No legitimate business wants to operate in a legal gray area, constantly fearing that their entire business model might become illegal overnight, or that their investments could be wiped out by sudden, unpredictable policy shifts.
Stability is key for business.
Essential. Clear, consistent regulations provide the certainty needed to attract significant investment, to scale operations, to integrate safely with traditional financial systems, and most importantly, to build products that users can actually trust. Regulators then act as this crucial bridge. They synthesize these diverse perspectives, the technical expertise from industry, the policy goals from government to create effective frameworks that are both technologically informed and legally sound. And this collaboration, it can manifest in various forms. Joint working groups, public-private dialogues, industry standards, bodies that develop best practices, shared research initiatives to tackle complex issues like DeFi governance, or cross-chain interoperability, or the nuances of digital asset classification. It has to be an ongoing conversation, a continuous feedback loop, not just a one-time pronouncement from on high.
And hand in hand with that collaboration, the material really stresses the need for transparent communication and a shared understanding to build this thriving and secure ecosystem. That also sounds like it needs to be a two-way street, right?
Transparency is absolutely vital, and yes, it's definitely a two-way street. It's fundamental for building trust among all the stakeholders, the users, the businesses, the regulators. When regulators are clear and proactive in their communication about their intentions, their interpretations of existing laws, upcoming regulatory proposals, it significantly reduces uncertainty for businesses. It fosters compliance. It helps businesses prepare, adapt, and build in alignment with evolving rules, rather than just reacting in fear or deciding to pack up and move offshore.
And transparency from the industry side.
Just as important. Transparent reporting from the industry, especially from critical entities like exchanges, stablecoin issuers, or major DeFi protocols, builds user confidence massively. When users can easily see clear audits, verifiable reserves backing assets, transparent operational metrics, they're far more likely to trust and engage with the ecosystem. It helps move the whole space beyond the current skepticism that's often fueled, understandably, by the actions of bad actors and past failures. And beyond just communicating clearly, there's this profound need for a shared understanding. This is deeper. It means actively bridging the knowledge gap that often exists. You have policymakers who might not be tech experts on one side, and you have blockchain innovators on the other who might not fully grasp the complexities of regulatory frameworks or financial stability concerns or consumer protection mandates. Education plays a massive role here on both sides, fostering a common language, identifying common goals, developing a mutual appreciation for each other's perspectives and challenges.
Getting everyone on the same page.
Getting everyone on roughly the same page, yes. This shared understanding helps craft regulations that are both effective in achieving their policy goals and practical for the technology they're meant to govern. It helps prevent situations where rules are imposed that are technically unfeasible to comply with, or that inadvertently stifle genuine beneficial innovation because the rulemakers didn't fully grasp the tech. It allows for a more nuanced approach, one that recognizes where decentralization truly adds unique value and where thoughtful oversight is absolutely non-negotiable for safety and stability. Ultimately, the full potential of blockchain, its potential to drive real innovation and have a positive societal impact, can only be realized when it is implemented responsibly. We started this deep dive talking about that revolutionary potential, didn't we? Financial freedom, enhanced transparency, unparalleled efficiency, how blockchain could transform everything from supply chains to healthcare to voting. But this revolutionary promise, it's truly conditional. It absolutely hinges on robust, thoughtful implementation and diligent ongoing oversight. Without that responsible approach, without the deep collaboration and transparency we've just discussed, the technology risks being derailed by its own dark side, by scams, by instability, by a pervasive lack of consumer trust.
The potential remains unrealized.
Exactly. When the paradox is successfully navigated, however, the positive societal impact could be truly profound. Greater financial inclusion for potentially billions of people, improved governance through more transparent processes, fairer distribution of value and new digital economies, truly secure, user-controlled data management. It's an exciting future to contemplate, but it's one that demands careful, collective stewardship from all of us.
Wow. What a journey we've been on today. From the incredible, almost utopian promise of financial freedom and transparency that blockchain offers, through the very real, sometimes scary risks of an unregulated Wild West, to the urgent need for this delicate balance between fostering innovation and ensuring protection for everyone involved, we've really seen how collaboration and transparency are not just, nice buzzwords. They seem to be essential ingredients for the future of this truly transformative technology.
Absolutely. As we've explored today, the future of blockchain and its profound impact, for better or worse, will truly depend on our collective ability to navigate this paradox successfully. So maybe a final thought for you, our listener, to mull over. As you think about this balancing act, where do you think the emphasis should lie? How much responsibility falls on the innovators to build responsibly from the outset, ensuring their code is secure, their intentions are clear, and how much responsibility lies with regulators to adapt thoughtfully, flexibly, and proactively, ensuring this powerful technology serves all of us safely and effectively in the years to come? It's a crucial question with no easy answer.